Hey folks, Dan Frio, the Mortgage Update. Today is August 4th, 2020. So what I want to talk about today is rates, and MBSs were positive today. Nothing enough to move the markets, but we're starting to hit some trend lines, and you're going to see as we hit those trend lines, we kind of dip back. So I think we're going to be stagnant on one of the levels that the ceilings that I post every day, but we're going to talk about that in a second. And then the economic calendar for the week, what that's affecting or how that's affecting what's going on with rates. And then there was an interesting article out today, or some information from the Fed, that one of the criteria that I monitor on a steady basis is what's going on with inflation, because inflation is the biggest component or the biggest fear of the Fed, as well as the bond market. So that's an area we want to talk about today briefly. And some weird information came out of the Fed that's I won't say weird, but we usually don't have deflation. I bet you probably didn't even know that was a word. Inflation is meaning, prices are going crazy high, but deflation is an area where prices start to come down because of there's not a lot of competition in a lot of areas of the market. But the Fed is a little bit worried about why isn't inflation rearing its ugly head? So they're coming out with some comments that's great for us. So let's get to it. So what happened today in the markets is, you can see here, is the MBSs were up 6, not enough to really do anything for rates. But here's that. Let's go through the triggers and the guides that I follow, and you guys follow. That's why you'll hopefully watch me every day. Is these trigger lines right here? These are called Fibonacci levels, and they keep adjusting. And if you're watching this on the podcast, I'd highly suggest you check it out. This video out on YouTube. Just go to YouTube and look up the rate update with Dan Frio, or just look up Dan Frio. I have about 600 videos there that you can follow. And but here's what we follow right now. These are areas, and I say this all the time just to make it clear, is think of these as bumpers. And the kid, you take your little kid out bowling, and he throws the thing down because you put the bumpers up, and it hits and bounces back and whatever. That's what these lines indicate. They're levels where we think that we're going to hit resistance levels in the bond market. And I won't try to get too technical, but what I want to show you here is, yesterday we talked about this line right here as being the new ceiling. You can see that we hit it today and we bounce back down, and I'm gonna say we're probably gonna ease up a little bit more by the end of the day to end up at that line right here. Okay. But some news coming out of the Fed was interesting, and I'll get to that in a second. But so here's what we follow here. We follow this number right here. What this number is what's going on in the bond market in regards to mortgage-backed securities. This is called the MBS market. And what the MBS is a bond that trades that has a whole bunch of mortgages in it, and it is actually the instrument or the investment that determines mortgage rates. As this number goes up, it means the price that people are paying for that particular bond is going up. If you pay more for a bond, it actually reduces the rate of return that you get on that bond because you're paying more. Okay, so the interest rate that you receive on that bond, or the rate of return, or in essence, the mortgage rate comes down. So we love when this number is going up because it's basically, in a roundabout way, causing mortgage rates to come down. Okay, so that's why we follow this. But how do we determine how is this moving? Why is it moving? And that's what we try to dissect on this channel. We try to follow a whole bunch of things, such as unemployment, employment, the gross domestic product, gold, oil, the stock market, the 10-year Treasury, the 30-year Treasury, a whole bunch of indicators on where we should be with mortgage rates. And that's what we're trying to predict, or that's what I'm trying to predict on your behalf. Because if I say, you know what, I can get you a rate at 3% and I end up getting you at 2.875, I think you're going to be pretty happy. I had several people come back today and they were getting rates at between 2.99 and 3%. On average, they were paying about $3,000 to $4,000 on those. Most of those people I came back with was offering 2.75 and about $800 in fees. So you can see that we're pretty much crushing that market. And I'll post a video right after this one. It'll be my Tuesday mortgage update video where I compare my rate in a particular category to rates all over the country with other places. But this one basically is the rate update. I'm trying to educate you guys on where rates are today and where I see them going based on past, present, future data. So that's what we're looking at right now. So right now, the Fed, not a lot of those instruments that I spoke about, employment, unemployment, the GDP, inflation indexes, none of that really is playing a toll on this right now. And it normally does. In a normal market, those things basically determine the direction of this. It's just like the stock market. It still blows my mind how the stock market is going up every day, but 30% of the country is out of a job. So how can that be? Well, the Fed. And the Fed has basically stepped in and said, we're going to do everything and anything we need to do to make sure that the economy doesn't just crash. And I'm going to show you that in a second. But let's go over what happened today in the markets. The Dow was up 165 again. Still blows my mind because, like I said, the unemployment rate is terrible. The GDP numbers are terrible. So why are things going up? And play this video back a year from now, and hopefully I'm wrong, but I think the market's going to have a correction here soon. But the good news is, or the highlight is, a lot of analysts, especially on CNBC and a couple other places, are coming out. CoreLogic is another. They're coming out with data saying that home values are going to crash. And you see a lot of clickbait right now on YouTube. What I mean by clickbait is people just putting these words out there that could shock you. And you go over and click it real quick saying, market's going to crash. The housing market's going to crash. I don't see that. And I see there's going to be some issues or some delinquencies because of all the people unemployed. But I don't see a crash like we had in 08 to 010 or 11, because back then there were a lot of loans out there that just didn't or shouldn't have been around. I've been doing this for 32 years, and there was a YouTube video I watched of a young man yesterday, and he gets millions of subscribers or in views, and I'm like, what's this kid doing? He was actually brilliant, and he's a realtor, and I'm like, this kid he's really got it going. He explained the whole process of kind of what happened back in 2008 to 11 versus what's happening today. And here's, basically what's happening is, or what happened back then is, there was a lot of just bad loans. If you had a 580 credit score, that was pretty darn good. You can get what's called a no income, no asset loan, no income, no job verification loan. No income, basically no, as long as your credit score was X, you could get a loan. And many times it was coupled with like an 80-20, meaning you want to buy a $100,000 house, we would do a first mortgage for 80%, and you can do a second mortgage for 20%. Basically, you needed no money down. So you're not verifying any jobs, you're not verifying any income, and you're financing 100% of the house's value. People were just going bonkers. And it was on adjustable rates. It was the recipe for disaster. Okay. Today's underwriting guidelines are pretty darn strict. I mean, a good credit score now is 740, not 580. You cannot get a loan if you don't validate your income. And how it's validated is it's whatever income you filed and showed on your federal taxes. That's how you qualify now. There are minimum down payment programs. About 3% is kind of the norm. 3.5, between 3 and 5% is what you normally need for your down payment. But underwriting is strict. You have to have money. You have to have a job. You have to have good credit. So those that are going to run into trouble are basically those who got hit by the corona. I won't say this in the bit, but by the corona bug, where maybe they lost their job, they owned the business, and the business had to shut down. They had a position, and now that position is eliminated. So you're not going to have the catastrophic results we had back then. And then you also have those that really are forced into the forbearance agreement where you can work with the banks, and that's iffy right now. But there are programs that allow you to refinance, skip two payments, put a little money in your pocket, and so forth. So there's a lot of stuff out there right now, especially with rates the way they are, that can really benefit those that really need the help. Not everybody, and I'm not saying that painting it with a brush that's saying everybody can be helped. There are going to be some issues where people are just but the housing market has been solid on value. So a lot of people, if they need to, they can probably get out of their homes right now without taking a bath, or you have a lot of people not walking away from their homes, because back when all this happened, you saw people would get 100% financing. So they would finance $300,000. And then the world started to crater. And then, they tried to sit there and tried to work and get a modification and try to work things out. And as houses began to sell and sell and sell and sell and sell, there was too many sellers, not enough buyers. It dropped values down. Well, when you're financing 100%, just a little incremental drop in the value, you're underwater. You owe more than it's worth. So let's say you have a $300,000 home. To sell it, you're going to pay a commission of say $10,000. Then you're going to pay other costs of maybe $3,000, $4,000, $5,000. So you're $15,000 in the hole right out of the gate. That's what happened. Right now, you're seeing, and we'll go through these CoreLogic numbers. You're seeing values up 4 or 5% a year. So and it's still, I think it's going to teeter a little bit. When more and more and more houses come on the market, because right now the values are going up because of limited supply and big demand. So let's go over what those numbers look like in regards to appreciation. So you can see through here that appreciation in the past year is averaging right now 4.9%. You can see that right in this area here. You have some big markets, Idaho, Montana, Missouri, and Arizona, all exceeding 8% appreciation. Don't take any offense to this, but Idaho, I can't even name a city in Idaho. So that being it. So sorry about that, Idaho. But you go down so that's what's going on in the market right now. We see good appreciation in the markets. The mainstream media is predicting a big drawback in values, and we're not seeing that. So don't be hosed by that data. Economic data, tomorrow we're going to see payroll numbers and trade numbers, and then the next few days we're going to see again what the employment numbers look like, as well as hourly wages and so forth. This can play some havoc on the market tomorrow. I think if the number comes out really good, it puts the Fed at a little bit ease, thinking, okay, everybody's going back to work. As they get back to work, they're going to start spending money, catch up on things, and so forth. If this number comes out worse or terrible, the Fed is in a position they can jump in because of inflation. The biggest thing they're fearing is inflation's going to rear its ugly head, and they're going to be stuck in a bad position. And maybe I'll do another video later this week about inflation and how the Fed monitors that as one of their biggest triggers that they follow. But their goal is to have inflation at a rate about 2%, and we're at 1 or under right now. And the Fed is now coming out saying that they're going to basically keep rates low until the point that they see inflation hit 2%, and then they'll start making some changes. So when that would be, don't know, but a lot of it's going to factor in on jobs and income. So that's the biggest piece of that. So inflation numbers, we just focused on that. I have my website is up, done, finished, and we are making one little tweak to it, but I hope you like it. This has been about 6 months in the works. Might not look like much, but there's a lot of data here. If you're looking to just get some questions answered, if you're looking to buy a home or refinance, you can click right here and funnel through. If you want to say, you know what, I want to get this going. I love Dan and what he's doing, and his team I think will take great care of us. Just go here and apply now. You can hit the apply now button. When you're down in here, you can pick one of my advisors or myself. The only thing I'm going to ask you to do when you do this, it's going to ask you down at the bottom of your toolbar to accept cookies or not. I need you to accept those. I'm not going to spam you or do anything else, but if you don't do that, you won't launch over to our application. You'll just launch into a questionnaire section that really doesn't do me much good. It just gives me a little bit of data from you. But if you do this and accept the cookies, you'll be in a full-fledged application. At the end of that application, based on what you answer, it's going to say, hey, we need this information from you, such as a W-2, a pay stub, and a bank statement. You'll be able to drag and drop your data right into that, and it'll go right into our system in a secure manner. Those that are watching me on YouTube, but you're like, you know what, I'd love to listen to some of this stuff and stay caught up while I'm in the car, on the train, or whatever else, you can go to iTunes, Spotify, all over the place and find me and all my videos. And what I've been doing since last week is I'm posting 2 videos a day, Monday, Wednesday, and Friday. And 1 video Tuesdays and Thursdays. Today will be a rate Tuesday, so I will be posting another. But I'm YouTubing that data and also creating podcasts with every one of those. And you can also find my radio show, my previous radio shows on this as well. There's there are a couple hundred probably in here. So just find what you like and click it, and hope you enjoy. So if I could be of any help to you personally, and you like what I'm doing, you like this, and you just want to say, hey, Dan, I'm in the mortgage process right now. I'm looking to buy a home. I need pre-qualified. Please reach out to me. The best way to get me is probably email, but let me go through all the information with you. Give me a call to reach me personally at 844-775-LOAN. That's 844-775-5626. There's only one of me, and there's thousands of you guys. So if one of my advisors answers the phone, please just give them all the information. You'll be in good hands because everything routes through me anyways. So you can talk with Alan, Jason, Donnie, Alex, Nico, Patrick, Dan, Frank. I got a whole bunch of people on staff that they're there to help you. I'd love to see you and connect with you on social media, Facebook, Twitter, YouTube, LinkedIn, Instagram, all those. But if you'd like to email me, you can email me at D for Dan, Frio, which is Frio, at preferredrate.com. What I'd like you to do is, this is what we're getting inundated with, and I love it, is if you're in the process of getting a mortgage right now and you need pre-approved, please click into this information here on our website and we'll get you pre-approved within an hour if it's during office hours. If you already have a quote, to buy the house or refinance, you're going to get what's called a loan estimate or a fee worksheet. And it's required. Or if not, ask your loan officer to send that to you. What we do is just email me that rate quote or that loan estimate or that fee sheet. That fee sheet's going to give me your loan amount, your address. With your address, I'll be able to pull up the value of your house. So now I have your loan amount, the value of your home. What I'm missing is your credit score. I need your credit score. So at least give me what you think your credit score is. If not, you can go to a sponsor of my show, the creditscoresandmore.com. It's plural, creditscoresandmore.com. And just go in there and click step 1. It's a free credit score. There's no gimmicks. Don't buy anything. Please don't buy anything. I'm asking you, I'm pleading to you. Don't upgrade, don't do anything. Just get the score. Send me what that score is. And with that, I'll be able to get back with you and say, okay, here's what I can do, or here's what I can't do, or God bless you. The quote you got is fantastic. Take it, run, don't look back. If you haven't done anything yet and your rate's at 4 or higher, please look to do something. We got to be able to put you in a better financial position somehow, some way. Most rates right now are under 3%. Yes, under 3% in almost all the programs we have. Even if you're getting we have a special program out in California. We have a jumbo up to $1 million. The rate right now is 3.375 with a half a point. It equates out to an APR of about 3.625. That's fantastic. I mean, fantastic. At 95% loan to value, meaning you only need 5% down if you're buying a house. So that's it. So I'd love to help. Hopefully you like my video. Please don't forget to give me a thumbs up. Subscribe down below. It's over there somewhere. Hit the bell. So at least every time I post something, you can at least get an alert saying, Dan posted this. If it's something you're interested in, watch it. If it's not, skip it. Don't worry about it. And I'd love to hear from you. So please comment down below. Let me know if there's anything you want me to discuss in detail. I'd love to do so. Otherwise, God bless. Take care. I'll see you in about an hour going over our Tuesday rate comparisons. Take care. Thanks for watching. Bye-bye.